Trump puts on tariffs, and the market don't care. The cash trade starts in 30 minutes. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, Trump's so-called Liberation Day is coming. The president is pushing ahead with tariffs on automakers and threatens more sweeping trade levies.
Despite the tariff drama, Morgan Stanley's Mike Wilson says don't count out U.S. stocks just yet. He'll explain why the Mag 7 is giving him hope.
Meanwhile, the chips are down. NVIDIA is set to extend losses into a third day, while AMD gets another downgrade. All that and more coming up, but let's get back to our top story of the day, and that is tariffs. Let's take a look at the domestic automakers pre-market. I wanted to point out GM in particular, now down almost 7% pre-market, a big reliance on Mexico, of course. Then you take a look at Ford faring a little bit better. Tesla up about 0.6%. Tesla makes sense. Ford, I will point out that about 80% of the cars that Ford sells in the U.S. are actually built here. So maybe that's why you see that resilience, Sonali.
Not so pretty on the other side of the ocean. We're taking a look at European car makers as well. Porsche, Mercedes-Benz, these will be hit hardest by the levies. According to a Bloomberg intelligence analysis, import costs could wipe out 1/4 of their projected 2026 operating earnings. And you could see Mercedes, Porsche, Ferrari all seeing declines in the European trade.
Yes, Porsche, I will point out, that's someone's name, right? And that's how you say it. Stellantis also getting hit today. It kind of straddles the Atlantic, right? Its headquarters are officially in the Netherlands. Of course, it's also in Detroit. They make Jeeps, they make Chryslers, they make Dodges and Rams. So watch those shares off about 2%. Now, Donald Trump says the tariffs will come into effect on April 3rd, initially targeting fully assembled vehicles, and will expand to include major automobile parts by May 3rd.
This is the beginning of Liberation Day in America. They've taken so much out of our country, friend and foe, and frankly, friend has been oftentimes much worse than foe.
Bloomberg's Tyler Kendall is at the White House to explain. So, Tyler, what do we know now about Trump's tariff timeline?
Yeah, hey, Matt. Well, importantly, when it comes to these auto tariffs, he said that they are going to be permanent, that he has no intent to negotiate them for any sort of exception down the line. He did add that he was in touch with the big three autos, and he told them they need to move their production to the U.S. if they want any sort of relief, as you well know. And you've been talking about this could really impact those North American car makers, considering that the supply chains are so highly integrated across the border. We're already starting to see, for example, lobbying groups for those automakers sound the alarm about consumer prices, not just for foreign autos, but also domestic autos, because of how many times the parts end up crossing the border. Now, we should note when it comes particularly to these auto tariffs, the U.S. is saying that it will impose a 25% tariff on non-U.S. content in USMCA compliant vehicles. It then, though, goes on in that executive order to say that USMCA compliant parts for now will not have any tariff, as the U.S. works out a process to differentiate between a non-U.S. content part and a U.S. content part. So a little wonky there, but important for our broader conversations about how this White House views its current trade agreements like the USMCA. But Matt, a big escalation here as we move forward, particularly because these auto sector-specific tariffs are just going to get stacked on top of existing levies.
One part of this that I think is interesting is those April 3rd tariffs on fully assembled vehicles, but the engine parts, powertrain components, electrical systems, that could also face tariffs by May 3rd, according to the order. Now, what do you think is the variability behind this? May 3rd is still a long way away compared to what we're seeing in the initial set of tariffs.
Well, Sonali, the negotiations are ongoing, but it remains to be seen really what this White House is specifically looking for when it could come to those potential exemptions or carve-outs, considering President Trump at this point says that he's not going to issue any. And we have to keep in mind that these sector-specific tariffs are going to go hand in hand with some other sector-specific tariffs we're expecting, such as on lumber, chips, pharmaceuticals, and then, as Bloomberg News has been reporting, in copper, importantly, too. It's all gearing up to April 2nd. We're going to have to see how our trade partners automakers retaliate and how this administration responds to that. Because yesterday we saw President Trump say that he's going to be fair and nice. Those are his words come April 2nd. But it remains to be seen if that's really going to happen, considering that this is considered to be a pretty big escalation.
Yeah, it's a good reminder. We have to get through April 2nd before we get to May 3rd. Tyler Kendall joining us from the White House lawn. Let's broaden out this conversation and take a look at how U.S. automakers are responding. Let's head to the Motor City. Bloomberg's Detroit bureau chief David Welch joining us now. And David, I want to talk about winners and losers. We had up a board of Tesla, of Ford, of GM. GM really standing out, down almost 7% pre-market. Talk us through the uneven impact here.
Yeah, GM's taking a big hit on this one. They make some very key vehicles in Canada, Mexico, and in Korea. Specifically, they have a pickup truck plant each in Canada and Mexico. It's their highest volume vehicle, the Chevy Silverado and GMC Sierra trucks, and very, very profitable for them. So they do have 2 plants in the U.S., but you're talking not quite half of the production for that vehicle, those 2 vehicles, being imported in. Now, those vehicles are USMCA compliant, and therefore they will be exempt, but the non-US made content on those trucks would be tariffed. So they will be hit to some degree. And GM will either eat it in profits or they'll have to try to pass it on to consumers. And then GM's 2 cheapest vehicles, the Chevy Trax and Chevy Trailblazer small SUVs that they sell to entry-level buyers, they come in from Korea, they will face the full 25%. So, you know, these are very tough tariffs for GM. Stellantis also, they make pickup trucks in Mexico and some key vehicles in Mexico. They're going to take a hit from this. Toyota will really get hit by this. About half of their volume sold in the U.S. is imported. So some of those vehicles are from Canada, so they'll get part of a tariff, and anything from Japan would get the full 25%. Those are the 3 companies that are probably hit hardest. Tesla makes everything they sell here, but they do import parts, so they will be they'll be subject to some tariffs, but because they build everything here, they get off a little easier than most car companies do.
So just to be clear, so you say it again, David, and everyone understands. My Chevy Silverado ZR2 was 73 grand when all was said and done in 2022, made in Mexico. It's not going to cost 92 grand now. They're not going to raise the price 25% because they won't be hit with the tariffs. It's UMCA compliant.
That's right, but let's say there's a $50,000 pickup truck coming in from Mexico. Let's just say, and I'm making this up, half of the parts are made in the U.S. and the other half are not. What would be hit by the tariff are the half that are not made in the U.S. So $25,000 worth of parts would be tariffed at 25%. So, you know, more than $6,000 in tariffs added to the cost of that vehicle that GM has to pay at the border. That's the way it would work, roughly. And then you will see later on some other tariffs on parts coming in once the Trump administration figures out how to actually levy them. It's actually tough to do. You have to dig into how it's done with every model. But that's how it would work with the pickup trucks. Pretty tough.
David, thank you so much for your reporting. That is Bloomberg's David Welch in Detroit. Now for a look at the global impact on these tariffs, we are joined by Bloomberg's Christoph Ravald in Frankfurt. We were talking about all the automakers across Europe that are affected by this, but Germany has really the bulk of the imports. How is Germany expected to respond?
Yeah, that is a big question right now. I mean, at the moment, the German manufacturers are basically pointing towards the European Union, which is the sort of like the negotiating counterpart for the U.S. administration. It's not done in Europe on a national level. But of course, pretty much everyone who's like related to the industry has pretty strong views on that, since there's a lot at stake. The German industry, or the German car industry, is the biggest industrial sector in Europe's biggest economy. So there's a lot at stake, basically, for the manufacturers and on the political side as well.
Well, Christoph, give us some context here, because, I mean, I think about Volkswagen in particular, and it's not like they were in a really great place even ahead of this news. I mean, what does the industry look like right now, and can it stand another hit?
Yeah, since you mentioned Volkswagen, they've been struggling really to increase their footprint in the US for quite some time. Obviously, what doesn't help right now is that while they do have a US manufacturing presence in Chattanooga, they do import a fair amount of vehicles from their Mexican factory in Puebla. So they will definitely see an impact from the tariffs as well, particularly when you look at their premium brand Audi, which currently doesn't produce any vehicles in the U.S. When you look at the other manufacturers, Mercedes-Benz will also very much exposed to the tariffs. They have a factory in Alabama, which is predominantly focused on SUV manufacturing, particularly like the mid-size and the bigger SUVs. But they, at the same time, also ship quite a few of their sedans, including the luxury S-Class sedan from Europe to the U.S. So that will be subject to tariffs as well.
All right, Christoph, thanks so much for joining us. Bloomberg's Christoph Rauwald out of Frankfurt talking to us about what's going to happen to the price of your Porsche 911 and your BMW M5 on Wall Street.
And the Macan and the Cayenne. This is what I know about the Porsches only.
I'm proud of you.
Thank you. I really appreciate it.
You've made a lot of progress in this last year.
It's all because of you. It is.
All right, coming up, NVIDIA is the most traded stock today. Shares falling on a report that there's a shortage of one of its chips. That report coming from Reuters. We'll have the latest next. This is Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. Wall Street bellwether Jefferies posting a disappointing first quarter thanks to a drop in investment banking and capital markets revenue. The decline is being attributed to uncertainty around U.S. policy and geopolitics, and the results mark a stark reversal from a year ago when momentum in trading and deals was starting to build. GameStop today down after Wedbush analyst said its offering of $1.3 billion in convertible notes will, quote, fall flat. Analyst Michael Pachter said it's hard to understand why any investor would pay more than twice cash value for GameStop to potentially convert it into Bitcoin. Pachter has a sell rating on the company. Oh, and the company said yesterday it's going to borrow money to buy Bitcoin. AMD is getting a downgrade at Jefferies. The analyst says the chip maker is falling further behind NVIDIA in its technological capabilities, and the gap will widen even more with NVIDIA's upcoming product offerings. The firm also cites increasing competition from Intel that may pose an additional risk to AMD. Sonali?
And Matt, another move that's on our radar, NVIDIA and H3C, which is a large chip server maker in China. They have flagged the potential shortages of the H20 chip by NVIDIA, and that's according to a Reuters report citing a client notice seen by the outlet. The drop you're seeing this morning, guys, it's only about 1.7%, but again, it is a big mover, and it also brings it closer to that 25% drop from NVIDIA's all-time high.
Right, clearly in a bear market there, at least for that one specific name. Just to give a little bit more context, H3C, it's one of China's largest server makers, and we're talking about NVIDIA's H20 chip. That is the most advanced AI processor that's legally available in China under U.S. export controls. Clearly just more bad news on that name. And that little bit of that drop that we're seeing in NVIDIA, down 1.7% pre-market, it's weighing on the broader indexes as we count down to the opening value.
Well, and don't forget, those H20 chips are exactly the ones that China is targeting in curbs. It's not allowing them because of their energy efficiency. So new regulations announced yesterday say that Chinese companies can no longer buy and use H20 chips.
Exactly. Of course, chips, specifically NVIDIA chips, really in the crosshairs of these trade tensions that we're seeing between the U.S. and China. Let's quickly check on these indexes, though. We were talking about NVIDIA's drop showing up in the S&P 500. Those losses deepening a little bit, down about 0.2%. It's big tech seeing the brunt of that selling, though, down about 0.3%. Small moves relative to what we've been seeing, but still some pain there. The Russell 2000 pretty much unchanged. We'll unpack it all with Morgan Stanley's Mike Wilson. On Monday, he said that last week may have been the bottom of this correction. We'll ask if he still thinks that's the case. This is Bloomberg. Wall Street is trying to game out the impact that tariffs might have on markets. Morgan Stanley's chief U.S. strategist Mike Wilson believes the tariffs are a starting point for negotiations rather than a, quote, clearing event. I'm thrilled to say that he joins us now at the desk. Mike Wilson, how are you?
I'm doing great. How are you?
So you wrote that on Monday,
yeah,
I believe. Is that still the case? Because we heard from Donald Trump yesterday saying that these most recent tariffs, specifically the auto tariffs, are permanent and that he's not interested in negotiating any exceptions.
Well, one thing we know about the president is he changes his mind back. I mean, this is a negotiating tool. The question is, how far do they have to go to get what they want? And the other question is, what do they want? So it's, like I said, it's the beginning of learning. We're going to learn more next week, and then we're going to learn more kind of as we go through this back and forth process. And how much do countries engage? We've seen a difference there too. Like Mexico seems to be engaging, Canada not so much. So this is going to be, volleying back and forth. But, I want to go back to our call for this year. Like, we were not that focused on tariffs because there were so many other things that were probably going to be a headwind for growth. And so even if this gets resolved, some of those other headwinds really don't go away probably until the second half of the year. And that's something just keep in the back of your mind.
What do you mean headwinds? Don't you still think the market's going to go up like 800 points by year end?
They could. I mean, we have a 12-month target of 6,500. I mean, I still stand by that. But that assumes that we can get to the good stuff of the policy by the end of the year. Now, maybe that 6,500 gets pushed out a quarter or so.
But that's your base case, right?
Correct.
So you do assume that we're going to get to the good stuff.
I think we are. I mean, look, and I think we've been right about this, which is I think people came in too excited that, oh my God, we got all this, pro-growth strategies, but that really isn't possible given the output gap. And that's what's very different about this term versus the president's first term. When he came in the first time, we had all this slack in the economy. And this time that wasn't available. So I think they're actually doing it the right way. The sequencing is, let's do the growth and negative stuff first, and we can go through all those. And then the good stuff like deregulation, lower taxes, maybe we get term premium to come down because the budget deficit looks a little bit more attractive. That's going to take time. And I think, it's interesting to watch. I mean, first of all, Treasury Secretary Bessent and then the president himself have really sort of confirmed that thesis. Every time they speak, they kind of talk to this idea that we're gonna have a tough 6 or 9 months, maybe 12 months.
Detox period.
100%. So. And that's a tough message for investors who've become addicted to policy.
So let's for a moment think about what happens if we don't hit that base case. So what are the headwinds that you see around the corner that are not related to the tariffs?
Yeah. Well, I think they're all related. So, I mean, not related would be that everything conspires together and it gets away from them. Like, I don't think the administration wants a recession. They want to slow things down, and then maybe they want to affect a recession in government. Okay. The question is that going to spill over into a recession in the private economy in a way where it's much worse? And in that scenario, then we're going to go lower than our 5,500 kind of first half downside target. Okay, we're not there yet. Like, our economists have cut their estimates, but they're not in the hard landing camp. The other thing I just want to bring up is, a term that we sort of invented 5 or 8 years ago was this rolling recession, right? We've had another one of these rolling.
You're in battle with Ed Yardeni now.
Yeah, well,
I thought that was his.
We could check the tape on that. But let's go back to the original rolling recession in 2018. But anyways, my point is that we've had another one of these rolling recessions. Okay, so why aren't we going to have a rolling recovery? In other words, as Scott Bessent has said, and we've been making this case for 2 years now, most of the private economy has been in a recession for 2 or 3 years. So what are we talking about? Like, in other words, if the government goes into a recession, slow down, negative growth, okay, does that mean that housing is going to become worse in the GFC? Because right now we're selling a number of homes that we were selling in 2012. I mean, that's kind of a recession. Okay, same thing for manufacturing, same thing for consumer goods. Call that we've been, underweight consumer goods for literally 3 years, and it's paid every year. Small cap stocks, it's paid every year to be underweight these areas. So the market gets the joke. I just think a lot of stock observers haven't really understood what's been going on here. The economy has not been strong. Okay,
right.
It has not been a balanced, good economy. It's been a very unbalanced economy. Strong government. Okay, strong services because a lot of rich people are making money off the stock market, and then you have this AI capex sort of driver.
Right.
But beyond those 3 areas, I mean, please tell me, where is the strength in the U.S. economy? Where has it been?
Yeah, no, it's a good question. And you think about the rolling recession, and you mentioned the AI CapEx story that really papered over a lot of the ills that maybe you saw if you looked closely at this economy. So if the play during the rolling recession was to just buy the indexes, bet on big tech, how do you play a potential rolling recovery? What sort of nuances do you look for there?
Yeah, so we're starting to do that work now. We've been doing that work. I mean, clearly, if you have a true hard landing, okay, the day that it becomes consensus, the first thing you want to do is buy the lowest quality stuff in the market. So consumer goods, right? You want to buy beaten up, really levered companies, bad balance sheet type businesses, maybe material stocks, energy stocks, the stuff that is really languished, that needs economic growth to kind of reset and then have a reflexive move higher. So in 2020 and 21, I think we were fairly out of consensus on this idea that we were going to have this huge operating leverage story coming out of the recession and the V-shaped recovery, and that was going to lead to this incredible earnings story. That's when you had a very broad stock market, right? When inflation is actually accelerating and you have pricing power. Today it's the exact opposite. Companies don't have pricing power. They can't really pass this on. So we've had a margin squeeze really in a lot of industries for the last couple of years, except for if you're a monopoly, okay, these large tech businesses or other businesses with scale, and they've been able to kind of manage this, the operational efficiency, the managing their costs and passing on price where they can. And so that market is still very much intact. So our core portfolio is still quality defensives and quality growth, and that's going to continue to work until one of two things happens. Either growth accelerates exogenously, like there's a new driver of growth, or we have a hard landing.
All right, Mike, I am happy to say that you're sticking with us through the opening bell, which is coming up next. Let's take a quick check on futures before we get there. You take a look at the most traded stocks right now. It's Ford, it's NVIDIA, it's Tesla, the names you would expect, and how it's filtering through into the benchmarks right now. The S&P 500 down about 0.3%, but it's big tech that's really taking the brunt here. That NVIDIA move lower really weighing on your big tech benchmark. We'll walk through all of it in the next block when we get to that opening bell on this Thursday. Don't go anywhere. This is Open Interest.
We are moments away from the start of trading on this, I guess it really feels like tariff day, but the market isn't reacting that much because we got 25% tariffs on autos, at least the announcement of. They won't go into effect until midnight on between April 2nd and April 3rd. But S&P futures aren't getting hit that hard. NVIDIA is a loser today, and that's one of the reasons you see a drop of 0.3% there. NASDAQ futures down a little bit more because it's NVIDIA, because those chip stocks, AMD, NVIDIA, are down. And you see the small caps there also off about 0.2%. On the New York Stock Exchange, I saw something that said IR impact, which makes me think of the Ingersoll Rand drills that they use in NASCAR, but apparently it's something to do with investor relations. They don't trade, so I don't care. And then there's Bailout International Group. They just started trading last week. This is a cloud-based internet platform that provides one-stop crowdsourcing, recruitment, and SaaS, software as a service enabled HR solutions.
Wow.
Who knows what they do? The point is they started trading at $4, and now they're trading at about $5 a week later, Katie.
All right, well, the line is going up, so good on them. But let's talk about where the line is going down, and that, of course, is with the auto stocks lower right now as investors try to suss out the impact that these tariffs will have on the supply chain, the companies themselves, and, of course, the consumer. You take a look at how the fallout is shaping up. GM is your big loser so far, down almost 6%, of course, very reliant on Mexico, as to is Stellantis. What's faring a little bit better is Ford. Ford is an interesting one, only down about 0.7%. Sonali, it was higher by 2% pre-market. About 80% of the cars that it sells in the U.S. are made in the U.S., so one of the relative winners here.
Sour sentiment largely on cars, except when you look at Tesla. It's up about 1.3%. It's largely seen as a winner from these tariffs. The domestic manufacturing operation here insulates it from many of the levies that its competitors face, Matt.
Yeah, although I think they got another downgrade today saying that they would lose another 50%, right?
A big one.
They're already 50% off of their peak. One good day doesn't change that kind of loss. Let's get back to the even bigger picture, the S&P 500. It's mostly unchanged. It's had a down year as well. Barclays sees the benchmark dropping even well, further than they did at the end of the year, right? 5,900, I think, is their year-end target. The strategist Vinu Krishna joined Bloomberg Surveillance this morning.
I have sensed this bearish sentiment on the rise, especially in the last few weeks. So I just came back from Europe. Without doubt, there's a negative sentiment, certainly in the U.S.
We're back with Morgan Stanley CIO and Chief U.S. Equity Strategist Mike Wilson. And Mike, you've been on a world tour. You've been traveling a lot for work to see clients. It's interesting to me that U.S. strategists, even you, who are kind of a known bear, think we're going to still go up to 6,500. All these European banks, Barclays and UBS, cutting their targets, HSBC, double downgrade. Do they just see it differently than we do here?
Well, I would say their path has been different, right? So once again, I think a majority of strategists and clients came into the year probably too bullish about kind of the trajectory. And look, we overshot all of our base case targets end of last year. We talked about 6,100 as our bull case. We were bullish. First of all, we were bullish in the second half of last year for very different reasons than most people. Most people were bullish because everybody was saying, oh, the economy's great, earnings are wonderful. No, what was going on was the Fed was cutting interest rates, okay? There was an election that we had a clean result in, which caused a lot of short covering and hedging coming off. And we had a recession getting priced out from the summer. So we just overshot. And then we have all these growth headwinds. So what I view is I think a lot of people are just catching up to what's happened. And so now, of course, they're marking themselves to market. We always had a 5,500 to 6,100 target for the first half of the range, for the first half of the year. We hit the low end of that range, so we got to be true to our original call. Once again, we can take out 5,500 in a hard landing. Okay, we're not there yet. I would say the risk of that has gone up. It's probably 30, 35% now. It's probably more like 10 to 20% at the beginning of the year. So that's what we're watching. We're just being more tactical, I think, than most people. Once again, clients right now don't care about year end. What they care about is making money in the next quarter or two. That's our job. And so we've been in the right sectors, we've been in the right factors for the most part, really for the last year. And as I like to say, proof is in the pudding, right? The numbers don't lie. Like our focus list is up 7% year to date.
Right.
So, I mean, that's pretty good. And over the last 7 years, it's up 80% relative to the S&P 500. So,
right.
Those are the numbers, right? The numbers don't lie. And because we've had the right call, not just in the last 12 months, but really over the last 7 years, understanding what's really going on in the economy and earnings, and understanding policy and the impact on valuation.
You mentioned that you're being tactical, and I want to talk about how tactical you're actually being, because there was a really interesting note out from Julian Emanuel from Evercore overnight. He says to buy options when the VIX is low, stocks when the VIX is high. Are you that short term? That seems like a very specific, narrow, you have to be quick on your feet there. Or are you looking out, when you say tactical, maybe a month or two?
Well, it depends on the client, right? So most of our interaction now is with institutional clients who have, time frames from 1 day to 2 months. Most people don't have 12 months. They're not trading their portfolio, turning it over that much, but they are looking to make money every month. And so that's how we gauge it. So it's usually a 30-day kind of window. And we made this call 2 weeks ago when we hit 5,500. Actually, we got literally to the number. And since then, we have rallied to, I think we could maybe rally 5,900, give or take. I don't think we can go to new highs. We're on record saying it's going to be really hard for us to go to new highs until earnings revision breath not only bottoms, but actually gets in positive territory again. And I think that's going to be challenging in the first half of this year. Now, as I mentioned earlier, I think in the second half, as investors start to look forward to 2026, we could see revision factors start to reaccelerate, and that will be when we could potentially make new highs, 6,500. Maybe it's end of the year, maybe it's early next year. Timing is, going to be uncertain.
Mike, my question is who's buying? Because the reality is the S&P 500 is still down more than 3% this year. The NASDAQ down almost 6% for the year. Hedge funds across the street have been clobbered through March, so I'm not quite sure what money they have to buy. Yeah. And so is there really dry powder on the sidelines to buy into these dips with conviction when you still could be worried that you break under that 5,500?
So asset owners remain very active, whether that's retail, pension funds. In fact, there's a rebalancing going on this week. One of the drivers for this rally in the last 2 weeks has been rebalancing from bonds back towards stocks. And of course, corporates are probably been the single biggest buyer of stocks, and there hasn't been much supply. As you know, the IPO calendar, equity calendar has been pretty light. So we still have kind of a good supply and demand balance. That will change. Like, when would the asset owners sell? The asset owners will sell when they think there's a major trajectory change, i.e. a recession, okay? I.e. The Fed has to raise rates again because inflation's really coming back. Neither one of those conditions is in place yet, but those are your risks, right? That's what will get the asset owner client to sell stocks is you get a hard landing or you get the Fed having to raise rates again.
By the way, so I always ask the same question, Sonali, because we always talk about retail is fully invested, foreign ownership of U.S. stocks is at an all-time high. But I think it's a good point that corporates will buy. In this administration, they'll embrace that as opposed to the previous administration. And we were talking during the break about retail clients used to have 60-40, right? 40 being bonds. And now you're seeing it more like 70-30, 30 being cash.
Yeah, well, it's not 70. It's low 60s. It's like 62. The big loser has been bonds. So retail investors who get a bad rap are not that dumb. I mean, they basically have been letting their long duration portfolio roll off as bonds have been by far the worst asset for the last several years. Now, could they buy bonds again at some point? Yeah, potentially.
But or they could buy stocks, right? If you look at money market funds,
sure.
We always pull up MMFA index on the Bloomberg terminal. It's up and to the right. And, you know, any sucker can get 4.5% now in a Marcus account or whatever.
Right. So they have a barbell. They're overweight. They're a little bit higher than normal on stocks, okay? And they're higher weight on short duration fixed income, i.e. cash in 2 years and in. That sounds pretty smart to me. Like that's been the right barbell. High quality stocks, okay, and short duration fixed income because you're getting paid a real rate of return now for the first time in like what, 15, 20 years? I mean, it's not a bad barbell. And then of course they're doing stuff in alternatives, whether it's private credit, which you're getting a pretty good return still, maybe some private equity, and of course they own real estate. We don't really have time for another question, but I just don't understand the pitch to go out into bonds when cash you're earning 4%, what the 10-year treasury yield is at 4.5%, 4.3%. It doesn't make sense why you would move out at all. Well, our strategists are bullish on bonds now because growth is slowing. Mm-hmm. The Fed eventually will be cutting more, and that will work its way in. So we could see yields below 4%, maybe 3.5%, even without a recession. And of course, if you get a recession, it's a great place to have some duration.
Mike, super nice to have you in studio today. That is Morgan Stanley's Mike Wilson. Complicated market we're looking at. We're going to look at some movers on our radar as well because Jefferies saw a drop in investment banking and capital markets revenue.
Woof.
Woof, right. Yeah, seriously. Due to a lack of M&A, they're down now 8%. They were down a little more. Also, woof, but the actual,
Petco.
Right, exactly. Hilarious. It's up a lot, up almost 32%. They see double-digit improvement in adjusted EBITDA for the year. And we've been talking about this all morning, guys. NVIDIA, check out NVIDIA now. It's down more than 2.6% this morning. There was a Reuters report this morning on potential shortages of a H20 chip, of course.
In China,
yes,
where
correct.
that specific chip, yesterday we learned from the FT, is going to be banned.
Correct. And now one of the largest server makers in the country, in China, flagged those shortages to clients, and that's what the stock.
You see why that's silly, right? Because
yes.
if it's banned, who cares about the shortage?
Well,
right?
I think
are we on the same page here?
I think it's more of a sign of the times.
Okay.
I mean, there's a lot of nervousness about demand, et cetera. Maybe we got ahead of our skis when it comes to the AI boom. But as you would expect, NVIDIA, obviously, your biggest weight on the S&P 500
over our
right
skis,
now.
Sonali.
What did I say the other day?
That's an inside joke.
That's cute. I mean, I've been off for about 2 weeks, so I'm just catching up. Just remembering how to do television, and I think I'm supposed to tease to this camera now, because coming up, one winner stands out in the wreckage of Trump's planned tariffs on auto imports, and that's Tesla. More on that next. This is Open Interest. All right, welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, AMD no longer a buy at Jefferies, getting cut to a hold, with the analyst saying that it's falling further behind NVIDIA and also facing increased competition from the likes of Intel. Next up, Phillips 66 getting downgraded, no longer a buy over at Goldman Sachs. Yesterday, the oil refiner nominated new directors to its board as it battles with activist investor Elliott. And finally, we have HSBC slashing its price target on Tesla to $130. Now, that new forecast suggests an over 50% downside potential for the stock, and the analyst cites limited driving assistant technology and challenges with European fleet buyers. Specifically, it's saying that robo-taxi opportunity, it's way too far in the future, and as such, it has a sell rating on the company, Matt.
All right, let's stick with Tesla right now. Elon Musk says the Trump tariffs will have an effect on his car maker. He tweeted, I guess we can still say that as a verb, quote, important to note that Tesla is not unscathed here. The tariff impact on Tesla is still significant. However, its large U.S. factories will help insulate the company from tariffs as compared to its rivals. Joining us with more is Bloomberg's Max Chafkin. He co-hosts the podcast Elon Inc., focused on all of Musk's businesses, but obviously Tesla is the big publicly traded one. And I have to say, as somebody who follows the car world, I'm really, I think impressed is the right word, by how American Teslas are. I mean, no other company has cars that are this much made in America.
Yeah, this is a real point of pride for Elon Musk. He talks about this all the time. Tesla is largely vertically integrated. It's not. They do get some parts from outside the U.S. They, as Musk is saying, there will be some tariffs, but they make a huge percentage of the car in their own factories in the U.S. There's also an advantage in EVs. EVs have fewer parts than gas-powered cars. So anyway, there are a bunch of reasons why this helps Elon, not necessarily helps Elon Musk, but doesn't hurt him as much as some of these other automakers.
Well, when we think about some of the pains that Tesla is feeling, it's not because of U.S. manufacturing, right? It's because people are not buying the cars in Europe. People are protesting. You're watching rivals in China.
Even here, not just Europe, right? Look at California sales. They're bad.
Yeah, and I mean, sales globally have been poor for the last year. They were down last year for the first time in close to a decade. There are real sales challenges. And in certain ways, yes, again, it gives Tesla some advantage if a gas-powered car costs $3,000 or $6,000 more because of tariffs. But if the economy is bad, it's not good for car manufacturers. It's not good for Tesla. I do think there are probably some Tesla investors, the bulls on the kind of robo-taxi thing, that generally look at this tariff thing as no big deal. Because again, they're going to make money from services. If you really believe that story, the cost of the car, even if the car price goes up a little bit, doesn't matter as much.
Interesting. And I mean, when it comes to those brand issues, the HSBC downgrade or price target cut is even more interesting because he writes that the seeds for the current sales weakness predates the recent brand issues. I mean, you add it all together and it seems like it's pretty dark out there for Tesla, especially, I mean, just going off the HSBC note, talking about that robo-taxi opportunity. There's been a lot of optimism built on that, but at least HSBC thinks that's well far into the future.
If Elon Musk did not have this close relationship with Donald Trump, I think it would be a much gloomier picture. And people will be talking about, a perfect storm. You have very few new models. They haven't really updated the cars much. Cybertruck has not done well. The electric car market is getting bigger. There's more competition. There are all these issues that have nothing to do with politics, nothing to do with the brand. And then you layer on top of that these kind of polarizing, the polarization in the country and the way that Musk has really leaned into that. And that, that adds to the stew.
Max, we could talk about this forever. We have to leave it there, though. Of course, a volatile ride for Tesla. That is Bloomberg's Max Chafkin. Now, coming up, we're going to talk about CoreWeave because it is planning to cut the size of its IPO. We're going to tell you why on the Bloomberg Scoop. You're watching Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. A quick check on what's going on in stocks here. We're looking at red arrows on the S&P 500 and that NASDAQ. Not huge. You might have expected a bigger drop on the day after President Trump announced 25% tariffs on autos, but you're not really seeing it. Take a look at some of the individual movers. NVIDIA is what's driving us down right now, off 1.2%, so well off of its lows for the session. Tesla on the way up because the product that Elon Musk makes for sale in America is a very American product, and it isn't likely to face much damage from Tesla. GM is the other story. They assemble a lot of their vehicles in Mexico, in Canada. And then you got a couple of rental companies here that I think are really interesting. Avis Budget Group and Hertz Global Holdings doing incredibly well. Wow, Hertz up almost 25% because as cars become more expensive, a lot of people are going to be renting cars instead. I don't know what the deal is with Lululemon, but
today.
Do you know?
It reports today.
It reports today.
Optimism.
Lululemon reports today, and we all need a little bit more Lululemon in our lives.
Thank you.
Anyways, we are going to talk about a stock that is not currently trading, but is going to look to list very soon. CoreWeave is cutting the size of its IPO to around $1.5 billion. It is a sign of how stock market volatility is hurting demand for even highly anticipated listings. The cloud computing company will announce new terms of the offering later today and has been planning to list as soon as tomorrow. Let's get details with Bloomberg's Bailey Lipschultz, who co-wrote this story and broke the details of the revised offering. This went from attempting to raise $4 billion to attempting to raise $2.7 billion, now to $1.5 billion. What's going on?
It's not a great look, Sonali, and it's really a combination of factors. When I talk to investors, long onlys, and hedge funds who have opted and told me they're sitting this one out, there's concerns about the competitive moat, how the longevity of the business will continue to operate in the years out. Obviously, we've seen headlines, Microsoft pulling back on spending as it relates to data centers. We've seen Joe Tsai come out and really question the future of that business and whether there's an oversupply of capacity. And really, just when you look at a deal like this, you're coming public at a time when you launch your IPO that as you mentioned, targeting $2.7 billion. NVIDIA over the last week down 4.5%. So certainly not helping with that concern, and obviously in the back of everyone's mind still is DeepSeek. And keep in mind, 8 of the 10 largest U.S. IPOs this year are trading in the red. Venture Global is down more than 55%, the biggest IPO of the year. So if you're a flipper, it's not really that exciting to go out on a limb and allocate some of your book to an IPO when you're really betting on the stock ripping 30%.
One thing that has nothing to do with this story, I will point out that co-founder Brian Venturo is a Haverford College graduate.
Oh, congrats. Did he run cross country there or no?
That would be amazing if he did, but I don't think so. But a long illustrative
So he went there, Howard Lutnick went there, and you went there.
Yes, and Alex Karp too, actually. So small,
an illustrious
but mighty
crowd.
Yeah, I know. Some real titans on that one. But in any case, you think about CoreWeave planning to downsize, according to sources. You mentioned the recent performance of recent IPOs. Talk to us about the effect this might have on some of those pipeline candidates that we keep talking about. Is this going to sort of chill the mood music?
It's bad.
Yeah.
It's bad. When I talk to hedge fund people who flip these stocks or even long onlys, the expectation was no matter what, CoreWeave can get this done. It's an AI play, it's computing, it's backed by NVIDIA. If there was a time or a company to break open the IPO market, this was the company. Now that, as you mentioned, Sonali, you go from talking about $4 billion to 2.7 to now 1.5, with NVIDIA, according to CNBC reporting, having to step up to shore up that book. There's a lot of uncertainty in what that could mean for other companies.
You know, the indebtedness is also something I want to talk about. There was this FT report about a technical default on the loans. I don't want to have you get too into that, of course, but I want to point out here that you have existing investors who have been particularly frustrated with the way they've managed their balance sheet. How often does the company's debt load come up in conversations with investors?
I mean, that's critical. It's normally, though, skewed towards private equity funds. So when you're looking at companies that are coming out of call it Platinum or Carlyle, your who's who, the real question is, what does that leverage profile look like? Less so typically with a fast-growing hyperscaler type of company like CoreWeave. As you mentioned, the company, according to disclosures in the IPO filing, violated key terms of a $7.6 billion loan last year, triggering a series of technical defaults that lenders have since agreed to waive. So there's been a lot of scrutiny around the filings, around the disclosures, and around the business operations and some of the deals that they have struck.
Bailey, thank you very much. Bloomberg's Bailey Lipschultz talking to us about the CoreWeave IPO. I'm looking at famous Haverford grads here.
There's a few of them.
Chevy Chase,
yes,
apparently.
I don't know if he actually graduated.
Judd Nelson.
Yeah, it's not bad.
From the Breakfast Club.
Go
Coming
Force.
up in the next hour, we have Bob Sloan of S3 Partners on short interest in Tesla. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, stocks extend losses as investors assess the impact of Trump tariffs on the economy.
This hour, we're going to explore how luxury consumers are bracing for Trump's tariffs and talk about a car that you want. Rob Dickinson and Raj Nair of Singer, a company known for resto modding classic Porsche 911s, joins Open Interest.
And from tariffs to tech, OpenAI is said to be finalizing a $40 billion funding deal that would double its valuation to $300 billion. Of course, a lot of eyeballs on that. It's a private company, and it's amazing that it's a private company and a real sign of the time that you have a lot of companies just happy to stay outside of the public markets. But let's take a quick check on these public markets. 30 minutes into the session, you can see the S&P 500 still lower on the day, but taking back some of those losses. Now down less than 0.1%. Big tech still in the hurt locker, relatively speaking, down about 0.2%. NVIDIA certainly weighing on sentiment there, but these moves contained after, I believe there's been a sell-off. I've been off, but I know that things have been pretty dicey.
You know what? It's shocking to me. Yesterday, when we heard that the auto tariffs were coming, I didn't get out of my car after I got home because I wanted to hear Trump talking. I wanted to see the market reaction. I always listen to Bloomberg Radio.
I know you do.
When I'm driving and sometimes when I'm cooking. And there just hasn't been what I expected. If you told me Trump is going to put 25% tariffs on automakers and actually go through with it and say it's going to stick, I would have thought...
You're talking on the benchmark level, right?
Yeah, I would have thought we see a huge sell-off.
Well, it's something that we've been talking about, tariff fatigue. Will he, won't he? There's some idiosyncratic stories, Sonali, but at the benchmark level, I just don't know how you play it.
I think if you pulled up how things have been performing this year, I think you'll see exactly why the benchmark level has not been responding in the same way. And it's because you see those super defensive trades leading the way in this pretty massive way. Your biggest performer on the year by far is the energy index. And actually, you saw a lot of the other parts of the energy index, the interesting parts that were tied to AI, sell off pretty brutally the last couple of weeks, Katie. You saw the likes of Vistria, which, of course, we were talking about all of last year as being one of the biggest gainers in utilities, dragging that part of the index down. So, yeah, it's still up on the year, but nowhere near where it was before.
And there's a lot of bad news priced in already. But, Matt, to your point, there's an interesting note from our MLive team, Michael Ball, saying that if you take a look at the options positioning around April 2nd, there's not too much to talk about. So clearly traders not exactly bracing for that date.
I think there's something to talk about in positioning.
We should.
That's why I called up my buddy Bob Sloan.
I'm talking specifically April 2nd.
I'm trying to get into this intro here.
I know.
Right? Tesla is down over 40% from its peak back in December, but it may be one of the rare winners coming out of President Trump's proposed auto tariffs. That's because all of the cars it sells in the U.S. are made in the U.S., and even most of the components it uses are made here. Joining us now is Bob Sloan, founder and managing partner at S3 Partners. And according to S3's research, short interest in Tesla has rebounded after trending downward most of last year. In fact, Bob, welcome to the show. Good morning. Thanks for joining us. I was shocked to see that there's only, I think, on the Bloomberg I see, only 2.5% short interest in this stock.
You know, Tesla is the metric of American culture. For the last 5 years, it has encapsulated everything economic that expresses itself in our markets. First, it's a meme stock. Then it's a financial soap opera fighting with short sellers. Then it's a technology stock. After the election, it's the best proxy of consumer sentiment and a political poll at the same time. It takes off in November, and then as tariffs and economic policy introduce itself, it sells off. If you want to understand consumer sentiment and reaction to economic policy, look no further than Tesla.
But Bob, one thing that really strikes me about the short interest you're seeing in Tesla is just how quickly the short interest has turned around. It wasn't too long ago that some of the largest institutional investors, short sellers, hedge funds, were too afraid to short this stock in fear of being squeezed.
Well, it's not, short interest was very low, as Matt pointed out early on. But so, who's selling the stock? It's actually your long holders. It's not necessarily short sellers putting pressure on the stock.
Yeah, it's interesting. I mean, we were talking to Carson Block a couple of weeks ago, and what did he say? Don't bet against Elon Musk. He always seems to find a rabbit to pull out of a hat. So maybe that attitude, it's working its way through the broader market as well. Bob, I do want to move on from Tesla, and I want to talk about small caps. It's a topic I keep returning to because this is a trade that just hasn't worked. I know that you're keeping an eye on the Russell 2000 ETF, ticker IWM. What are we seeing when it comes to that short interest story?
Yeah, so we're not an investment advisor. We're a data company. Let's just keep that in mind. But one of the things that we've done is invert technical analysis. Most of the time, technical analysis is done on the broader market. We've done it on short interest indicator. And what you find is that when short interest gets to its resistance level and hits it, that's generally bearish for the stock. And actually for IWM, it broke out of its resistance level and then actually about 89 million shares and then came back down. So near term, probably bullish signal for IWM.
We were talking about a story Michael Ball wrote for Bloomberg, kind of calling the non-event that tariffs would turn out to be, at least for today, because of options positioning. When you look at, short interest going into, say, COVID or going into Russia's invasion of Ukraine, what can you learn? What lessons can you pull out of that and apply now, short interest going into tariffs?
Sure. So exogenous events are a fact of life, right? I mean, you mentioned many of them: COVID, Ukraine invasion, now tariffs. And what short interest does, it actually helps you understand how the market will react to exogenous events. So COVID, what happened? You had airlines sell off, but you had consumer staples like Clorox, P&G being bought. Same thing with Ukraine. You had, food being sold off, energy being bought. So now what we see is those companies and or sectors like XOY, XOK, where you have either a dependency on foreign revenue or you have a lot of your manufacturing being made outside the United States performing poorly. So short interest is a factor. It is very much like momentum or interest rates or value in and of itself to apply to risk management in your portfolio.
Bob, what kind of signals are you seeing when it comes to the short interest in the major indexes when you look at ETFs tied to the S&P 500, for example?
Yeah. So SPY, short interest is going through the roof. It's broken through its resistance levels so much that it's actually probably setting up a new support level. That's called polarity. We see that, and we think that's bearish for SPY.
I also want to go around the world here. We've been talking for a few months now about this outperformance that we're seeing when it comes to European equity markets relative to U.S. equity markets. A lot of concern maybe that U.S. exceptionalism is fading, but it's a little bit of a different story. I mean, looking at your notes, as I understand it, people are sort of betting against that rally that we're seeing in Europe, Bob.
Well, uncertainty breeds a certain amount of hedging activity. And I think you're seeing that express itself in European markets for sure.
Hey, Bob, Jamie Dimon and Steve Ratner both have made the point that the people they know and speak to on Wall Street, even those who didn't vote for Donald Trump, are still very optimistic for this term. And I wonder, you're also exceptionally well connected on Wall Street and here in New York. What are you hearing from the business community about, the current vibes, for lack of a better term?
Sure. So, well, first of all, thanks for the compliment. The second thing is stress tests out, Basel endgame in the cooler, balance sheet expansion is here. So when you look at the regulatory environment, that's the next step in economic policy. There's probably $1 trillion of balance sheet that's available. In the coming years, there's probably never been a better time for fund formation. And what we're seeing is a recharacterization, reformation of market-making capital happen right before our eyes. There will be more multi-strats. I know people think that's a tight space, but the balance sheet will be available. And I think a great time to be in the fund formation business.
Bob, we thank you so much for your time today. That is Bob Sloan of S3 Partners. Now coming up, bankers were dreaming of M&A riches under President Trump, but it hasn't worked out yet. We're going to talk about what's going on next in the Wall Street Beat. This is Open Interest.
Let's get to high interest, look at what's making headlines around the world. A panel of financial experts suggests the Fed should consider setting up an emergency program that would close out highly leveraged hedge fund trades in case there's a crisis in the treasuries market. The program would involve hedged bond purchases, and the panel says that would be a more efficient way to intervene in the market compared with the Fed's massive outright purchases of treasury securities in 2020. I don't really understand it. It's about the basis trade, and I just put that story in there for Sonali. Now, Health and Human Services Secretary Robert F. Kennedy Jr. is announcing plans to cut 10,000 employees from his department. He will also cut down on the number of regional offices and consolidate HHS departments. The changes are estimated to cut costs by $1.8 billion a year. An ex-Paulson partner, Orkun Kilic, who shuttered his hedge fund about a year ago, is relaunching. The London-based Berry Street Capital Management will start trading as soon as next month with capital from Qube Research and Technologies. The move comes at an uncertain time for M&A. Bankers anticipated the Trump administration would set off a spate of deal-making fueled by deregulation, but uncertainty over Trump's agenda has spooked markets, keeping deal-makers on the sidelines.
Matt, for you, I'm going to make like that open call on Bloomberg Television to invite Ken Griffin to speak to us about the basis trade, because some of those traders are the biggest in the game, but they might now face a backstop. Let's see if the Fed agrees with doing so. We're going to switch gears. We're going to go to the Wall Street Beat. We are going to talk about that M&A drought, because across Wall Street, the world's leading M&A advisors are sounding the alarm. The Trump-driven deals boom that they'd all been dreaming of isn't happening yet. Instead, deal-making is essentially on hold, according to top bankers at Morgan Stanley and UBS, and it's the subject of today's Big Take. Bloomberg's Michelle Davis co-wrote the story, joins us now, senior reporter on the team, and has been chasing all the deals happening and then all the deals falling apart. It's kind of crazy. You list a whole host of deals that have either been stalled or completely let go. There has also been regulatory pushback in ways that people have not expected, like you saw with HP. What ultimately would bring everything back to the surface?
I mean, deals want certainty, and so that's what is causing everything to be put on pause. And I think what's really interesting about what we're seeing right now is, if you look at the numbers, it's actually not bad. We're up on last year at this time, slightly, but it feels horrible because right after the election, everyone was predicting this massive flood. You should have heard some of the bullishness, you know, that bankers and lawyers were talking about, and it just hasn't panned out that way. So it just feels a lot more awful than it is.
Yeah, to put some numbers to that, you had a senior strategist over at Goldman saying that originally he had predicted a 25% increase in U.S. M&A this year. He slashed that to just 7%. So we're still coming up, but just the levels are so low, it's hard to get excited.
Yeah, and what really makes it hard is, you know, if you're a company and you are impacted by tariffs or the economy or the consumer, and with things changing so fast, it's really hard for you to make a plan about betting the farm on some big dream deal if you don't know what the world's going to look like tomorrow, much less a year from now, 2 years from now.
You know, I heard a lot of strategists yesterday on Carol and Tim's show.
Yeah.
Bloomberg Business Week.
Daily, they
Yes.
changed the name.
And so many of them were saying, like, we're waiting for things to calm down. We think that this flurry of action is going to consolidate into some kind of stability. Is anyone really believing that's going to happen in this administration?
Well, so that's the other take, that what we can predict is that it will continue to be unpredictable. And so if you just take that, maybe there are ways to adjust to the environment and it becomes a new normal, and you learn to maybe bake in certain terms that allow you to adjust valuation based on, you know, how tariffs or other policies pan out.
Michelle, thank you for all of your reporting, for joining us here on set. That is Bloomberg's Michelle Davis. Follow all her work. And it's interesting, just yesterday you guys were talking about how the bonus pool on Wall Street surged to a record. I have a hard time imagining that this year looks anything close to that.
$47.8 billion.
Something like that.
Was the Wall Street bonus pool for 2024. That is huge.
Yeah.
More than a third higher than it was in the year previous. So the average Wall Street bonus was $244,000 and change.
Yeah, we'll have to see how exactly that gets distributed. I know that Michelle's team will be following it.
Yeah, you know, you look also, let's take a look at Jefferies shares because it's a good kind of bellwether for a lot of reasons. They report before all the other banks do, and you see the shares still dropping almost 9% because of that drop off in investment banking and capital markets revenue. Remember, it's not just M&A. This is also capital raising that it's not bringing in as much as expected. Again, uncertainty is the reason why. And the results mark a stark reversal from just a year ago when momentum in trading and deals was starting to build.
Jefferies is considered a bellwether. Did I tell you the etymology of the word bellwether?
You didn't, and I'm dying to hear it, Matt.
So I would think it's something to do with rain or snow, you know, like weather. But actually, it's Belvedere from the Middle English for a castrated sheep.
Oh.
A castrated sheep would wear a bell around his neck, and he would lead the pack, and that's where you get the term bellwether.
And that's what Jefferies is, a castrated sheep.
With a bell around its neck.
Yeah.
Moving on, still ahead, you know, we're going to talk about what could be the largest fundraising round of all time. We'll discuss the latest on OpenAI next. This is Bloomberg.
Well, Bloomberg has learned that OpenAI is close to finalizing a $40 billion funding round led by SoftBank. Now, that comes as the company is saying that it expects revenue to more than triple just this year. Joining us now is Bloomberg co-host of Bloomberg Technology, Caroline Hyde. Caroline, it's interesting to compare and contrast here because you have, of course, OpenAI just trying to raise gobs of money here. And then you have CoreWeave slashing its IPO size in half, according to sources. And it really feels like haves and have-nots as we sort of question the AI story here.
We question the AI bubble. We question the AI infrastructure bubble. OpenAI is building and using the infrastructure to give us all the applications, the image generation that everyone's going completely wild about right now, and starting to prove the use case both for businesses and to individuals. They're actually also showing that revenue is tripling for this year. That's reporting coming from Bloomberg. It's likely to double again into next year, up to about $30 billion. There we have the revenue streams. You go to CoreWeave, which is at the infrastructure layer. Basically, they're providing the compute for OpenAI to serve us all our wonderful images. That's where we question. That's why Joe Tsai from Alibaba is saying, I think there's a bubble going on in the US. That's when TD Cowen comes out and says, look, Microsoft seems to be pulling away from some of its overall leases. And who is the biggest customer of CoreWeave? Microsoft. And so this is a terrible time to be checking IPO and AI sentiment from an infrastructure perspective with the public markets. But on the private markets, it's go, 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 and up to $30 billion going to be coming from alone the likes of, well, SoftBank, and then another $10 billion coming from other investors like
They better get that cash while they can, right? Because you know, it's getting dark out there. There's not going to be any more money. I feel like there's a rush to grab as much as they can right now because everything's going to be made in China later and all cheaper. I think it's also interesting that Microsoft apparently is backing out of leases. Haven't we talked about this before?
At least according to TD Cowen once again.
And it's the same people that we all had this animated discussion about back in February when we were trying to understand exactly what leases really mean and the technical terms about when you've signed for them and when you haven't. But TD Cowen is sticking to their perspective that Microsoft is moving away from them in Europe. Now, it does go out to say, look, they're being snapped up. Those data center leases and indeed desires to build are then going to be bought by Amazon. They're going to be bought by Meta. Maybe it's the relationship with OpenAI and Microsoft being recalibrated, and we know that OpenAI is now allowed to go to Oracle, it's now allowed to go to SoftBank, and of course the overall Stargate project for its compute. So Microsoft off the hook a little bit. But Microsoft has said, look, I'm sticking to my $80 billion investment theme for this year. That should bode well overall for CoreWeave, but it's just speaking to our anxieties right now. And I think you're right, Matt, that there is a rush to get this over the line. Why does overall OpenAI need $40 billion? For its compute? The question is it going to CoreWeave or is it going to other people?
They should just get their chips in China. They can get them way cheaper there.
One thing that's fascinating to your point on the investors, there is investor overlap, a lot of it, frankly. And you look at the OpenAI story, Magnetar, for example.
Yeah.
They are in CoreWeave. They could put another $1 billion in OpenAI. Now, that's kind of why I almost feel the same way you do. At what point does the money flow stop? Because these investors are so overloaded in the same theme where there is pressure, like it or not. OpenAI is not expected to be cash flow positive till 2029.
I think it's all about timing, isn't it? At the moment, we are accessing an IPO market when valuations are down 25% for NVIDIA over the last month or so, 10% for the overall NASDAQ 100. It's just an ugly moment in the short term to be questioning valuations. But VCs and Magnetar, for example, very long-term perspective. I don't think anyone's questioning how much generative AI is going to change yours and my life in the longer term, but they are questioning where they get compute from in the here and now. And I think there's like the mismatch that's happening in the market and the private markets. But eventually, these things do tend to come together. Is it more that the private valuations calm down, or is it more that the public markets start to pick up once tariff anxiety is out of the way?
Yeah, some big existential questions embedded in that answer. Caroline, it's always great to see you. That is Bloomberg Technology co-host Caroline Hyde. And be sure to check out the premiere of our new Bloomberg Original show Primer. It's all about the business behind technologies poised to transform global markets. That's tonight at 6 p.m. Eastern.
I love the tease, by the way. I love the commercial for that. You did a fantastic job.
Oh, a voice.
I watched
you should
it
see
twice.
it's an amazing collaboration, Bloomberg Originals. They got some incredible production value on it. It was a real joy to be part of.
Cool.
Yeah, it's been beautiful watching it on Instagram. Excited to see the full package. That's tonight at 6 p.m. Eastern. Let's quickly get a check on these markets, though, before we get there. You can see the S&P 500 coming back a little bit right now. The biggest gainer on a points basis is Tesla, currently up by about 2.5%. The tug of war there is that you have NVIDIA shares down about 1% right now. That is your biggest weight on a points basis to the downside. Now coming up, Singer continues to dominate the resto mod auto category. We'll speak to the company next. This is Bloomberg.
Jerry Seinfeld famously called his 1973 911 Carrera RS a dead man's car because it's the kind you buy from someone's estate and keep for the rest of your life. That's the kind of car that Rob Dickinson is building at Singer, but with an outlaw twist. Singer has absolutely dominated the category of resto mods, taking a classic 964 from the 1990s and kitting it out to perform far better than the original, all while adding unique non-factory touches for which well-heeled buyers are willing to shell out millions. In fact, the former frontman for the shoegazing rock band Catherine Wheel has gotten so many orders that he teamed up with Knighthead Capital to help finance the whole thing and has recently brought in former Ford exec Raj Nair to sell those $1 million 911s. Joining us now from their new production facility in Torrance, California, are the man himself, Rob Dickinson, and his new CEO, former Ford president Raj Nair. Great to have you guys on the program. Thanks for joining us. Rob, I'll start with you. Just set the stage for us in terms of like the genesis of Singer and the explosive growth that you've seen over the past 5 years.
Hi, Matt. Thanks for having us. Yes, it started with an idea that formed in my brain in around about 2004, 2005, where my passion for the Porsche 911 had produced a car that I'd built myself. It was my vision of a perfect 911, and other people seemed to like it too, and it formed this idea that could we take this incredible German sports car that had its classic era with an air-cooled engine from 1964 to 1989 and create a celebration of it, a kind of ultimate optimized version that paid homage to Porsche, but also espoused a philosophy of excellence wherever possible, at any expense, I suppose, an indulgent celebration of what we believe is the most important sports car in the world, the Porsche 911, done with some sincerity and some understatement, dare I say it, and with some with as much attention paid to the engineering as the design, and a deep dive into celebrating what is truly an iconic car. And I think my vision of what that car should be was the same as everybody else's, and I think that's probably why we've had some success.
You've had massive success, huge boom through the pandemic as well. And Raj, maybe you can comment on how sales are going now, because we had consumer confidence fall to the lowest level since 2021, and yet I'm guessing your order books just continue to grow.
Yeah, we're very fortunate. We actually have a 3-year order book, all individual customer orders where we're, reimagined customers 911s. We just delivered our 500th car, about 100 vehicles or 1,000 vehicles sold, coming up on 1,000. So, yeah, we're very bullish about the order book, and we've got a pretty full product pipeline even beyond that, out to 2030, where we've got a lot of ideas with Rob and team on what we can do in the future.
Let's talk a little bit about the competitive landscape here. And Rob, I'll toss this question to you. You do have sort of copycat companies that have popped up. I'm thinking about Theon Design, Twisted Automotive, for example.
Gunther Works.
Gunther Works is another one. Matt is obviously the authority here. But how do you sort of meet that competition? What is the pitch for people continuing to buy Singers when you have prices that are much higher than some of your new peers?
I think we've managed to prove over the years that what you get with what we do is what we promise. We have a mantra at Singer is that everything is important, and our work is absolutely about the cars, but our work is about many other things as well. We're a service business, and we're taking a lot of money from our clients, and the idea is to honor that, repay that trust with not just a brilliant car, but a brilliant experience, a journey. These incredible folks that trust us with their money become friends, and they're real relationships. And I think that means a lot when you're spending a lot of money. I think our cars seem to, on the odd occasion, people sell their cars. They make some money from them. Our cars are, I think, a good place to put your money if that's an important thing, and it is to many people, of course. And I think we continue to push the barriers. We're aware that we've inspired a few other people. I think in many ways that's been great. In many ways it's a sign of that we're doing something right. I think if people start to be inspired and copy us, I think everyone copies, and everyone is inspired by others. Sometimes it leads to good things, and sometimes it leads to copies. So
Rob,
we remain stoic about that. It's all good stuff for us.
Rob, that's the relationship to rivals and clients. But what about to Porsche itself? Now, calling it a reimagined Porsche, what are the ramifications of selling a Porsche that is not a Porsche? What are the legal ramifications for calling it reimagined without infringing on trademark laws tied to Porsche?
Well, it is a Porsche. It's a Porsche all the way through. It's a Porsche when we start, and it's a Porsche when we finish. I think we're paying honest and sincere respects to Porsche. We respect their trademarks, and of course, it's an incredibly important company. And a company that's inspirational to us. I think a lot of companies that enter into the custom car world are beating their own chest a little bit. For us, it was always Porsche writ large and Singer writ small, in that this is really a celebration of a car company we love and a car that we love. Clearly, we've built a business around it, but I think we've done it with some sincerity and some authenticity that I hope Porsche appreciate.
Raj, I want to ask you about tariffs in a roundabout way, really about costs, right? When I first started looking at Singers, they were pricing out at, I think, $400,000 to $500,000, and now it takes probably $900,000 to get into the game. With my options, I'm sure it would climb to $1.5 or $2 million quickly. How much have costs risen, and what effect do you see from these new tariffs that we've heard about from Donald Trump?
Yeah, so we're actually about 1.1 million to about 3.6 million on the cost of the services right now. Up to about 1.6 million, that could be personalized content. So yeah, very high priced vehicles. We're obviously very low volumes, and we're not really buying many of those raw materials and other parts, whether it's steel, aluminum. We're buying finished components from suppliers and then assembling those to vehicles. We're only at 200 services a year is what we're targeting. We want to keep it that way and keep it exclusive. And so our order bank being 3 years out, we've got a lot of that material already. So the near-term impact for the tariffs is pretty minimal for us. It's obviously a huge impact for the automotive industry at large. But for us, it's not as much of an issue. And the fact that we're providing services means, within our contracts, should we see inflationary price increases, we do have the ability to raise the prices for the services. We hate passing that on to the consumer, but our consumers, are ultra-high net worth individuals, and so maybe a little less sensitive to the price increases than the general consumer for the automotive market. So recognize it's a huge issue for the industry, but we're fortunate enough to be in a segment that it's not as much of a concern for us.
Rob, what else can we look forward to from Singer? I mean, the classic design, as you said, understated, very elegant, and that's what made you famous. We were showing video of the DLS, which is less understated, to say the least. What's next from Singer? Could we see, for example, an electric Singer?
You could ask me how many people have asked us to reimagine a Porsche 911 with an electric motor, and I can tell you it's zero. For what that's worth. That's not to say we find electric vehicles repugnant. We don't. I've just arrived in an electric Porsche Macan that is very impressive. At the same time, I think the internal combustion engine has a lot of life left in it. Intrinsically, it's quite an efficient way of motivating a vehicle, as I say, I think it's where our passion is. It's the gasoline is the thing that pumps through our veins, and I think there's more to come from us with internal combustion engines. There's a lot to come from us in further celebration of Porsche, and we clearly have become known for doing something quite particular, and I think that is an enormous opportunity for us as a company. We have some wonderful clients. We have a reputation we're proud of, and as we go forward, we start to think about what our options are, and I think we have a few. But the next few years are more Porsche for sure.
All right, guys, really enjoyed this conversation. Hope to do it again soon. That is Rob Dickinson and Raj Nair of Singer. Meanwhile, let's get a check on these markets because we have a turnaround on our hands. You take a look at the S&P 500, the NASDAQ 100, both breaking into the green. The S&P 500 up about 0.2%. You can thank Tesla for that. Currently higher by about 5%. That is your biggest gainer from a points percentage on the S&P 500. You take a look at what's moving to the downside. It's the chips. It's Broadcom. It's NVIDIA really hurting today. But when you have Tesla really roaring higher, Amazon too getting in on the action. And you can see it's all adding up to higher stocks right now, at least at the benchmark level, Sonali.
And let's get a look at some of the stocks moving this hour with Bloomberg's Alex Semenova. Let's start with the autos, shall we?
Hey guys, so U.S. car makers are really taking a hit today as President Donald Trump says that a 25% tariff on auto imports is set to take effect next week. Peers in Europe were also falling this morning. Analysts said that Ford and General Motors were some of the companies that were set to be biggest hit by this, while companies like Stellantis and Tesla were a little bit better positioned. And I was reading some of the Wall Street reactions to what this means for the sector more broadly. Bernstein analysts said that this move represents a profound disruption to the automotive model globally, and Jefferies said that this is the most heavy-handed option by the Trump administration. So really, this is a sector that has been really susceptible to some of the tariff announcements, and we're set to keep an eye on it as these go into effect.
Man, I don't know how Stellantis is well positioned. I mean, my Challenger was made in Canada.
Yeah.
And I think maybe at least 30%, if not more, of their American brand vehicles are manufactured in Canada. or Mexico. So very interesting. On the other big mover in this market is chips, right? And we've been focused on NVIDIA, but AMD also got a downgrade.
Yeah, that one has been in focus this morning. Analysts at Jefferies essentially came out and said that it's falling behind in the AI race. Blaine Curtis, an analyst there, said that the estimates on Wall Street are way too high for the stock as competition heats up from Intel. It also pointed to a GPU benchmarking report that said basically that NVIDIA retains a significant performance advantage over AMD. To put it bluntly, Jefferies is basically saying that AMD is not even in the same league. And this is actually the 8th downgrade this year for AMD. The stock was down about 9% this year through yesterday's close.
Yeah, it even said that, Jefferies said that Intel could be rising competition for AMD. Intel, a sort of American icon that's been in the hurt locker, but that's a real sign of the times there. Alex, great roundup as always. Our thanks to Bloomberg's Alex Semenova. Now coming up as the trade war intensifies, we'll speak tariffs with the expert, Mary Lovely of the Peterson Institute. That conversation is coming up next. This is Open Interest.
Now let's get back to the top story of the day, the Trump tariffs. And Mary Lovely is a tariff and trade expert. She's a senior fellow at the Peterson Institute, a think tank that specializes in international economics. She also served as the co-editor of the China Economic Review from 2011 to 2015. Let's zoom in to what we're seeing right now, because of course you have the auto tariffs, you have a threat of more tariffs when it's tied to auto parts, and you see it in the market reaction today and how European car makers versus U.S. car makers are doing. What is the market not seeing, though?
I mean, I think the market is reacting to what is really a very radical policy change. This is going to dramatically affect U.S. auto operations. And I know part of that is intended by the president, who wants assembly to be back in the U.S. But the U.S. auto industry has maintained a competitive stance by basically relying on Canada for doing part of its operations, and Mexico largely for lowering labor costs in assembly. So this just blows a hole into those strategies, a great big hole.
One of the things the president was saying yesterday, Mary, is that the media doesn't tout enough the fact that manufacturing has moved back to the U.S. bigly. And I wonder if that's been the case. Have you seen that? Or do you expect that? Do these tariffs really drive manufacturers to say, you know, we were assembling the Silverado in Mexico, but now we're going to bring all of our plants back to Detroit?
Well, this is a tricky issue. It's clear that there have been announcements in the auto sector of new investment, and I would expect that given yesterday's announcement about 25% tariffs across the board, that we're going to see more. Unfortunately, that's just the tip of the iceberg that you can see. Underneath the water, there are a lot of investments and investors that are thinking, is the U.S. the right place for me to locate? Unfortunately, these non-investments won't ever be seen because they're deflected away from the United States. Also, the quiet disinvestment that will happen as U.S. companies face lower demand because of the increase in prices that we're surely going to see. You know, with the U.S. raising tariffs virtually every week, sectors not knowing if they're going to be hit, how confident would you be in building a new manufacturing plant in the United States unless you were building it strictly to serve a market that is now being walled off from the rest of the world?
And Mary, for so long, we've been talking about tariffs, the threat of tariffs as tactics, basically. And I was spending the last several days at a conference out in Las Vegas, and many of the conversations I had were around how actually Trump 2.0, you have to take Donald Trump at his word. You have to take him literally. And one of the things that he said yesterday when introducing these auto tariffs was that these would be permanent, that basically these aren't negotiating tactics. Do you believe that? Should we reframe how we've been thinking about this back and forth?
I would believe it. It's not clear that there's been any ask at all of foreign governments as to what they could do. We know that In previous statements, President Trump has criticized the EU for their 10% tariffs on passenger vehicles. There's been, and the EU said, well, okay, we're willing to lower it. Let's talk. There's been no uptake from the Trump administration. So I think that this time we have to take him at his word and expect that it won't be rolled back.
One thing I'm wondering is what the ultimate impact would be in terms of actually helping the American economy. To Matt's point, a lot of the reason we're seeing this is because there are tons of people who want to see manufacturing brought back to the United States, jobs brought back to the United States. But in the terms of jobs in particular, our own Joe Doe makes this great point that steel tariffs are not going to bring steel jobs back to the country per se, even if you have the manufacturing back. How much is this really going to have an impact should we see the tariff strategy play out as told?
Well, it's a complicated question because protection can add some jobs in the sector that is protected. We know that it tends to decrease and in fact lead to job losses in sectors that use those products as inputs. This is why the Trump administration, when it levied tariffs, 25% tariffs on steel and aluminum, and removed agreements that the Biden administration had in place, and particularly with Europe, he did it by also placing tariffs on derivative products that use steel, including things like kitchen utensils and a backyard soccer goal for your kids. So they're really putting a very large fence around the United States. And here they're also going for auto parts. There is a temporary stay related USMCA certified parts, but that's temporary until the Trump administration is able to figure out which part of those parts contain American content. Because as your viewers surely know, this industry is fully integrated across the three countries. So looking at a vehicle, it's very hard to say exactly where in North America individual parts come from. So the operation, the enforcement mechanisms, just how to do this is not even worked out. So I think we see here that there are going to be protection up and down the line, and in the long run, that cannot be a strategy to grow the economy. We know that from time and time again experience of countries that have tried it.
Well, Mary, that's a good note to leave it on. Great to get some time with you. Our big thanks to Mary Lovely of the Peterson Institute. Meanwhile, let's get a check on these markets and the rally that is building right now in the S&P 500, up by about 0.2%. The NASDAQ 100 higher as well by a similar amount. Tesla really pushing up both of those benchmarks, even with the weakness that you see in chips. And then the bond market in its own world right now. That sell-off continuing. 10-year yields higher by about 2 basis points, knocking on the door of 440. Much more markets coverage coming up next. This is Open Interest. All right, welcome back to Open Interest. We do have some headlines breaking right now. This out of ratings agency Moody's, edging closer to a downgrade of the U.S., specifically higher tariffs and tax cuts to boost deficits. This according to Moody's, and that debt overhang could outweigh the strength of the dollar. Interesting coming from Moody's. We know that S&P downgraded the U.S. Fitch followed not too long ago. And now we have Moody's, again, edging closer to maybe also potentially downgrading the U.S.
Yeah, I mean, this comes down to pure just numbers. Higher tariffs, tax cuts is what they're looking at here. And of course, we're looking at that X date in the coming months as well when it comes to the congressional budget.
Yeah, and as a result, I think, at least partially, gold has been driven to a new record high. You're looking at $3,058 a troy ounce. Coming up tomorrow on Open Interest, Lisa Shallett joins us from Morgan Stanley Wealth Management, Laura Goodwin of New York Life Investments, and Flexport founder Ryan Peterson. This is Bloomberg.